In today's video, we're going to do a bit of a follow-up inside of the S&P 500, specifically with regards to these Fibonacci levels that we've been tracking for quite some time. If you're new to the channel, or this is the first time you're finding out about these Fibonacci levels, I would recommend watching this video right here, which was made 2 weeks ago, along with this video made 6 days ago, in which we build the Fibonacci levels together, and then we do a little bit of a follow-up, which should give you some more context to this video today. Now, since we made the last video, we've had the S&P break outside slightly of the lowest Fibonacci levels that we had, and we immediately recaptured that level. With today's activity, we had such strength that even the edge signals indicator is currently printing as of today's close, suggesting we're officially in oversold territory. So this right here is typically our setup that we're looking for. We want price to come inside of a key level and then confirm that, hey, we're officially now in oversold territory. We expect to bounce from there. However, I'm a little hesitant and a little wary that this overall fib level is going to hold in the grand scheme of things. If this level were to hold, then that would suggest that, hey, this bull trend that we've had ever since October of 2022 is still holding intact, and we're now making a bounce from there. However, the reasons why I'm a little hesitant are what I'll share in today's video, and we'll also have some signs in which we know that, hey, we're wrong, and in fact, this bull trend is very much intact. We should actually be looking to the upside. So the goal here is to first lay out the bias in what the market is currently telling us, and then know where things need to change in order for that bias to also adapt to whatever the market's telling us. Now, first off, if we zoom in and we take a look at this downtrend that we have, this has been ever since February of 2023, we connect all of these points, we can see lower lows starting to form, and we're now seeing price action come right back up, and it's getting close to this zone right here. So if we were to tag, say, the upper end of this trend line, that should serve as a resistance point. Now that also overlaps fairly nicely with this key round number 400, which also overlaps with the upper end of our Fibonacci level here. This level is not really all that useful when we're looking at it as a point of resistance, but I find it interesting just in the spirit of confluence of a bunch of different things coming together. The real key here is that 400 price point along with this upper trend line. So that's reason number one. We have this lower lows, lower highs trend that's currently forming, which would suggest a little bit more bearishness. Reason number two, if we load in the market pulse indicator here, and I click apply, the market pulse is currently red, and we can see that with the label right here, which tells us we're currently in a stage of deceleration. Now you might argue, if we zoom out, that while the market pulse is currently red, we've been chopping around now for quite some time. We've been hovering between green to gray to red to green to now most recently red. You might argue that, hey, if the market pulse breaks above this market pulse will turn green. And that's true. So to dive a little bit deeper, we can zoom in to not only the S&P 500, but other sectors as well. So for that, I'll load in our utility labels indicator. The market pulse and the utility labels, by the way, are completely free, and I'll leave a link to download them in the description box below. Now, if I load in the market pulse and the utility labels, we get a sense of the broader sectors as well and what they're telling us with regards to trend. Now, one thing should stand out here, and that's if we look at the markets here outside of the put-call ratio, there's no label that's currently presenting itself as a green label, suggesting we're in a stage of acceleration. The S&P is red, the Russell is red, the Dow is red, Transport's red, XLF red, XLY red, XLP red, IBB red, XLV red, Energy's red, XLB red, and XLRE and XRT all red. So a lot of sectors across the board telling us that, hey, we currently have weakness there. We're in a stage of deceleration. And all that means is price action in whichever market we're looking at is trading below the 10-period volume or variable moving average, and we have our 3 sets of volume weighted moving averages also stacked bearishly. So that tells us that a majority of the sectors inside of the broader market right now have weakness. So let's zoom in on these 2 sectors here to see, okay, well, what is XLC and XLU telling us? If I start with XLU first, XLU here, while the label is showing yellow, and we can see that here with the stage of accumulation, the overall trend when we zoom in is still very much red. That line makes it really easy to see, so we can see this recent strength has taken price action above that variable moving average, but if say we were to close below this, this label would go from yellow to orange. So there's not a whole lot of bullish strength supporting XLU. The one sector where I think there is still some strength is XLC. XLC here, a little bit different compared to XLU. We can see that same majority green. Now we went to red, but that red was short-lived, and today's price activity looks pretty strong inside of XLC. There's no two ways around that. So in terms of the one sector right now, which I think is holding us intact, which might lead to strength in other sectors as well, is XLC. Now our sign here for us to be able to say change our bias on the S&P 500 to me would be if more of these sectors start to follow suit, similar to what XLC is doing. If we start to see XLC go green, some of these other sectors go yellow, then that would suggest that, hey, there's broader sector participation here. This level inside of the S&P is still holding. This bull trend since October 2022 may just be resuming, and our bias here is completely wrong. Now, if we don't see that happen, and instead we see price action tag this market pulse, we start to see that resistance really near this zone right here, 400. Price starts to tag the 400 zone, the upper end of this trend line. We start to see a little bit of resistance, weak candles, ones that look like this, where we have strong wicks to the upside. Then to me, that would suggest that, hey, our bearish bias is intact. We can start to look at least some weakness. And in the broader scheme of things, if say this bear market, this next leg is to continue, we have some downside levels which take us to 348.97, 334.69, and 318.41. Now, all three of these levels seem like they're incredibly far away for the time being, and I'm not sure that they're going to be in play for quite some time. However, we do have a shorter term plan that we can use to navigate these markets, both on a day and swing trading basis. On a day trading basis, we can see the shorter term strength, and we have some nice magnet levels on the upside that we can target. For the longer swing trading basis, be waiting for this 400 price point, see how price reacts from near that zone, and I'm hoping we start to see a little bit more bearishness kick in, which to me gives us the better risk to reward opportunity, given that we have some longer targets to the downside. All right, so I hope this video was helpful for those of you following along with these fib levels, and hopefully this exercise of doing some consistent follow-ups on these same levels is useful for those of you tracking along. Good luck, everyone. I hope you close out this week strong, and I'll see you in our next update.